When we think about big financial risks, our minds usually jump back in time, right? We think about the crash of 1929 and the Great Depression, or maybe 2008 and the Great Recession. These events have become our benchmarks for understanding what can go wrong.
But what if the next crisis doesn't look like 1929 or 2008? What if it's something different? In today's explainer, we're going to walk through a specific analysis that makes a pretty bold claim, that right now, we're facing a unique storm that combines the worst risk from both of those periods all happening at once.
And this quote right here, this is the core thesis of the argument we're examining. The idea isn't that we're in a single isolated bubble. No, the argument is that we're in three massive bubbles simultaneously, creating a scenario the source calls the everything bubble.
So here's how we're going to break this whole thing down. First, we'll look at what these three bubbles actually are. Then, we'll explore the eerie parallels the analysis draws to 1929 and 2008. After that, we'll see how a potential crash could cascade through the system. And finally, we'll cover the source's ultimate warning.
All right, let's dive in. The first piece of this everything bubble puzzle, according to the analysis, starts in a place we all watch pretty closely, the stock market. Now, this slide highlights a really key metric called the PE ratio. In simple terms, it's a measure of how expensive stocks are. And what the source points out is that right now, that ratio is sitting at 28, which is nearly double its historical average. A level this high is, well, it's pretty rare and has historically shown up right before a major market downturn.
And on top of that, the analysis points to this: extreme concentration. Get this, just 7 massive tech companies make up almost a third of the value of the entire S&P 500. So the argument is that the fate of the whole market and a lot of people's retirement savings is dangerously tied to the performance of just a tiny handful of companies.
Okay, moving on to the second bubble the analysis identifies: real estate. This chart is pretty stark. It shows that today's home prices are a whopping 50% above their long-term trend. Now, to give you some context, back at the absolute peak of the 2008 housing bubble, they were only 35% above trend. So the implication here is that this bubble is actually bigger. And it's not just our homes. This slide points to a huge crisis brewing in commercial real estate. Thanks to the shift to remote work, office buildings are sitting empty. The problem is, there are trillions of dollars in loans on these buildings that are about to come due. They'll have to be refinanced at today's much higher interest rates, which could trigger a massive wave of defaults.
And that brings us to the third and final bubble. And this one's a bit of a mind bender, because it's supposedly in the one thing we're all taught is the safest investment on the planet: government bonds. With federal debt skyrocketing to $36 trillion, the analysis argues that this traditional safe haven has become a huge source of risk all on its own.
Now, to really build its case, the analysis doesn't just look at today's numbers in isolation. It draws some pretty direct and unsettling comparisons to the two biggest financial meltdowns of the last 100 years.
One of the first parallels it highlights is the extreme level of wealth inequality. The source draws a line from the Roaring '20s, right before the Great Depression, to today. Back then, the top 1% controlled about a quarter of the income. The analysis claims that today, the top 1% controls nearly a third of the wealth. Very similar pictures, just decades apart.
But here is a critical difference that, according to the argument, makes our current situation so much more fragile for the average person. In 1929, only about 10% of households owned any stock. Today, that number is 58%, mostly through retirement plans. This means a market crash is no longer just a problem for the wealthy. It would directly gut the financial security of the majority of the population.
Now, let's compare today to 2008. The analysis argues that our policy toolbox, the stuff we use to fix a crisis, is basically empty. Think about it. In 2008, the Fed could slash interest rates all the way to zero to boost the economy, and the government had room to borrow for bailouts. But today, the argument is those emergency levers are already pulled or broken.
So given this whole setup, these three bubbles, the empty toolbox, the source then lays out a few indicators that it claims are flashing red, and walks us through how a crash could actually cascade through the whole system.
So what are these warning signs? Well, first, there's something called an inverted yield curve. It's a bit of a wonky term, but it has a nearly perfect track record of predicting recessions. On top of that, you've got record levels of people falling behind on their credit card and car payments, corporate insiders selling off their own company stock, and even famous investors like Warren Buffett sitting on record piles of cash, as if they're waiting for things to go on sale.
The argument then lays out this potential domino effect. It could all start with a single, small trigger. Maybe a huge company reports bad earnings. That sparks fear, which leads to forced selling, pushing the market down even faster. As losses pile up, maybe smaller regional banks start to fail from their real estate loans going bad. And before you know it, you have a full-blown crisis.
And all of this leads to what the analysis calls an impossible choice for policymakers. What do? Do you print trillions of dollars to bail everyone out and risk destroying the currency through inflation? Or do you do nothing and risk a devastating deflationary depression? According to this source, there's just no easy way out.
So, what's the end game here? Where does all of this lead? Well, the analysis concludes by focusing on a potential human cost if this scenario were to play out. The source warns that the fallout could be so bad and the recovery so long that it might create what's called a lost generation of retirees. These are people who would see their life savings just wiped out with absolutely no time left to rebuild. It's a situation that has historical precedent, like what happened in Japan after its huge market crash back in 1990.
So, just to recap the whole argument we've been walking through, it's this idea that we're facing a unique combination of threats. You've got the stock market overvaluation of 1929, the housing and debt problems of 2008, plus this new, looming government debt crisis that makes everything more complicated.
And this really is the crucial point of the entire analysis. The problem isn't just that these bubbles might exist. The bigger and, frankly, scarier issue, according to the source, is the idea that the very tools we use to fight the last fire might not work this time around.
And that really leaves us with a final thought. Look, regardless of whether you believe the specific grim analysis is accurate or not, it forces us all to ask a really vital question. Just how resilient is our financial system? Understanding the arguments about these kinds of vulnerabilities is the first step toward preparing for what is sure to be a complex economic future. Thanks for joining me for this breakdown.